Okay, welcome everybody to this week's edition of Self Wealth Live, the technical analysis edition. Last week we did a pre-recorded session. I hope you're able to view that or see that. Actually, I'd love to know if any of our viewers or repeat viewers actually did watch it. Just so we know that in future, if we can't make them, pre-recorded sessions are worth doing, right? So that would be great. And I actually didn't mind. I enjoyed doing a pre-recorded session as well, right? I hope you did, Jace, too. How are you today?
Hi, Roger. I'm good. Yeah, look, pre-recorded, I think, worked well last week, but we're back live this week, so that's always good. So we've got those questions from the viewers. So if you've got a question, yeah, let me know. Let Rog know. We can get into them for you.
Yeah, we'll chuck any of the questions you have at the start of the show, I guess. And if you're a new time viewer to this, we go through the markets, the Australian market, the American markets, and the Hong Kong market, because that's what we offer at Self Wealth. And then we go through a few general questions around technical analysis. We've already got a couple set up for today. But if you have any, we'll try and fit them in. So do chuck them in the chat. All right. And then at the end, we'll go through a few of your tickers and we'll analyze what we think from a technical analysis point of view. Once again, Jason will specifically, obviously, as our resident expert around these things. So, Jason, I've moved position in my house because I think after about almost a year of doing these sessions, I had to match you and I had to put a painting up, just like yours. What do you think about my painting? I'll show everyone that. What do you think? It's not my pick, I can tell you that much. So
it's like walking through a gallery, seeing the it moves from my side to your side. It's good. I love it, Rog. Love a bit of artwork in the background.
Yeah, very good. Thank you. It's nice to hear. I don't mind a bit of artwork. To be honest, I'm not an art person. This is my wife's choice. So, but yeah, look. Also, don't feel free to vote on whose artwork is better, Jason's or Roger's. All right, feel free to put that down in the chat and comments as well. All right. I'm not sure if there's a prize attached to it, but it's just interesting to know. G'day, Makus, g'day, Jack Keys, and g'day, Alistair and David. Welcome to our live show today. All right, Jason, before we get started, let's have a look at our disclaimers, please.
Okay, so everything today, general commentary only, no personal advice, and this little disclaimer will just run through all that. And of course, I'm not part of Self Wealth. My business is Motion Trader. So that's the top disclaimer. You see my licensing details there, and below there you'll see the self-wealth disclaimer. And again, everything it outlines there is about general advice only, general commentary. It's not no personal advice given.
Yeah, fantastic. Thanks, Jason. All right, well, once again, the markets are in middle ground at the moment from what I see. It's starting to come up a little bit. They're starting to, or some of them are starting to come up a little bit. What are your thoughts on the Australian market this week, man?
Yeah, lots happened over the last week since we did our last video. So we'll go into the jump over into the charts and start to have a look at the ASX 200. And so I think the concern people generally get when we get these declines or these pullbacks in the markets, people start worrying about, well, look, is this going to be the start of a larger decline? And also we've got prices breaking below this support around 7,720 last week, just getting back above it in the last couple of days, but generally much of the price action has been below this support. I don't think the recent selling is necessarily a big deal. And I think the weakness probably shouldn't come as a surprise. Like this is something we've been discussing. We've been discussing this scenario over the last few weeks. And that scenario is that the ASX 200 is trading within potentially looking to trade within a broad trading range or a longer consolidation. And the difficulty I've had with the market just quickly snapping back to a new high, this is something we've talked about a bit. It's that we've had this big advance off the October low, ran for 5 months, strong gains there, and just the way markets work, big rallies, they need time to back and fill before potentially rallying again. And that's what I think we're going through now. I think we're going through that consolidation phase. I thought that when we saw this break below 7,720 last week, I thought that was going to open the way for maybe a retest of the April low. But so far we've got a nice strong bounce coming back off the 100-day moving average, and that's encouraging. I think that indicates that there's interest in buying the dip, and that's what we want to see. We want to see this pullback being supported. Maybe the market doesn't get back to the April low, maybe it does, but this is the thing with these trading range consolidations. They're often just a bit messy, and it's hard to navigate every stretch of it. But I think that ultimately, I think that's what we're doing. I think we're consolidating. We've got some nice clear levels to keep an eye on the top side, and that being the high from May and the high from April. Couple of ways we can look at this. One way would be just to say, look, let's just put on an overhead resistance band, something like that, just connecting the highs. That comes in around 7,920 thereabouts. Another way we could do it, we could actually start to look. We're getting enough data in this now, enough price action to say, well, look, maybe this is, let me just draw this in. Maybe we can draw in like a trading range. So there's the upper boundary. I'm pretty happy with the upper boundary, and then the lower boundary. Maybe that could form up. I won't put this line in at the moment though, because it's really only bounced off it for a couple of days. So there's nothing to say that this couldn't come back down a bit lower, and this trend line ends up being at a lower point. But tentatively, something like that, you can now get a nice visual on a trading range. So let's just remove that for now. I think it's a little bit early for that one, but we've got a couple of good markers for the top side. While the ASX 200 remains below this sort of 7,920 sort of region, I think the consolidation scenario remains in place. If we see a break above that resistance, well, I think that's then a bullish signal that we're starting to look for the upward trend resuming. I still think the overall trend is up, and nothing here is suggesting otherwise. What's important now, I think, is that we just, as I was saying before, we see pullbacks being supported, and this consolidation continues to build out. My approach here, Rog, hasn't changed. It's still long the market, wide trailing stops. I think stocks could be like, we could see the ASX 200 back at all-time highs within a few months. And if that's to be the case, I still want to be holding the good stocks in my portfolio. I don't want to get shaken out on a consolidation, on a pullback. But then again, if this does start to roll over and turns into something else, well, I've got that exit plan, that trailing stops, the wide trailing stops. It's an exit plan. So should things take a turn for the worse, I've got to, I know my way out. Won't be a case of just watching the market fall away and not knowing what to do. And I think having that exit plan is always important, no matter how you're approaching the market.
Yeah, it's interesting. Someone, can you draw the channel from November 23? Michael's mentioned how he's got a channel from, longer term channel from November 23. Is that also valid there, or?
November 23. Well, that's the low 5 months ago. Look, I think, let's just see. Like, the only way I can really draw a channel is using the April low, or even the most recent low. But I don't think, like, you can
up channel.
Yeah, like, I don't think that's not how I draw a channel. And the reason I wouldn't do that is because whilst the upper boundary of the channel seems to pick up all these highs nicely, it's really hinging off this April low. And and you certainly can't use the low from a couple of days ago. It's sort of like, yes, we've got these highs that line up, but you can't get the bottom line until you get this point over here in April, which is just ideally, like, what you'd get, be able to draw a channel. You'd have the market from one of the earlier highs. It would come back and give you the lower the lower boundary at an earlier phase and then start to sort of like move within the channel there. But because this second lower point is just only reasonably recently, I don't think it really works to put in. It's not really a proportion channel. We need this lower boundary point further down the line, at an earlier stage rather than just in the most recent price action. So I don't. This is a thing when you're drawing lines on charts. It's easy to just connect up lows and create a trend line. But why not connect that point there? Well, it didn't work out. Then why not connect that point? Why not connect that point? So you can always connect points, but they don't always mean a great deal. I'm not sure this one's going to stand the test of time as being a really good anchor point for a trend line.
This kind of reminds me of a lesson that I had taught once when I was learning a lot, at the beginning of technical analysis. And one of my mentors at the time was saying, "Hey, you can draw a line randomly anywhere on the chart, and there's going to be some form of support and resistance that you're going to hit." So it's once again, everything's open to interpretation, like in anything in this day, like with everything, right? So, but I found that so true, right? You could just draw lines randomly on charts, and there's generally going to hit some sort of support and resistance, right? So,
I see it all the time. I see people call up charts in all sorts of time frames, and you can put a hindsight line on to make a point. Well, pretty much anywhere, but we can't trade off a hindsight line. We've got to work off what we can put in now, and what can that help us understand about what could be coming. I tend not to put too many trend lines on charts anymore. That's how I initially started my early teachings in learnings and technical analysis was all about trend channels and trend lines. I don't tend to use them so much anymore. I prefer to use the moving averages as sort of more like dynamic trend lines. And I'll sparingly use a trend line or a trend channel from time to time if it's a really good one with lots of touch points. The example we just put in didn't really have the touch points for me on the low side. So that's why I wouldn't use it. I prefer the moving averages. But also these horizontal lines, I find they can be useful, like support and resistance, and also like maybe a downward sloping line for firming up a range. I think they're useful because we can see those compressions in the price action. And when the price action compresses, it's like a spring. It will then compress to a point where you get a breakout. And when you get a breakout, price action then starts to expand and you get trends. So I find they're really helpful. Some of the trend channels and trend lines, it's too easy to draw something which isn't going to stack up as time passes.
Okay, let's have a look at the US markets then.
So let's jump over the S&P 500. This is actually a fascinating setup. We've had two key reversal days within about a week, and I'll show you. So this is here's the first one. So this is a bearish key reversal where we have the openers above the previous close, and then it closes the day below the previous low. Bearish reversal. We spoke about this last week. What turns up on Friday is it's a bullish reversal where the market actually opened a touch above the previous close, but it did then trade down to a new low, and it closed the day above the previous day's high. So we've got a reversal to the upside. So I can't remember seeing that in price action before. We've got the two reversals within a week of one another, pointing in opposite directions. It's I think it's encouraging that this second key or the second reversal has occurred just near the 50-day moving average. So as I often do, I've got the 50-day and the 100-day moving averages. So the S&P 500 has come down in this 50-day moving average, found buying interest, and it's had a rally off there. So looking at this chart on its own, it looks like a new all-time high isn't that far off. But it's the general pullback in the market that really gets my interest on this. And like just looking at this, you're really saying, well, there's not really much of a pullback. It's just really like a little dip to the moving averages and starting to rally again. But there's a bit more to it. So on the surface, that's what it looks like. But when you shift your focus to some of the market internals and even some of the indices, you get a different picture. I'll show you what I mean. So just take a mental snapshot of what we've got in the S&P 500 over the last week. Now let's jump over to the Dow Jones. It's a much steeper pullback, isn't it? There's more of a decline which has taken place in the Dow, and so the Dow's off about 5%. About a week or two. It's taken a week or two to travel from an all-time high back 5%. So in itself, that's not a big deal. But it's interesting. The S&P 500 is holding up relatively well, and there's been this more pronounced weakness across stocks generally, which you can see in the Dow. You can also see it when I go to an equal weight. I'll go to an S&P 500 equal weight. This is an ETF, and again, you can see it's been more of a pullback in the equal weight, and also the equal weight hasn't confirmed the all-time high we got in the S&P recently. I'll quickly jump back to the S&P. So see, we've got a new all-time high in the S&P 500 and a very small pullback. Go over to the equal weight, didn't make a new all-time high. We've had a bit of a larger pullback. So what does this all mean? Well, I think the price action in the Dow and the equal weight, for me, that suggests that maybe this broader period of consolidation still has a bit longer to play out. Like I was saying in the ASX 200 earlier, big 5-month rally in stocks, and after these rallies, you often get the consolidations. And I think this consolidation, I think it has longer to play out. We could see several months of back and forth within a range. I'll jump back to the Dow. So like just say, we can just let me just put a box around this to identify the range. So and I don't know the timing of this, but say we could see price action continue within this rectangular area for another month or 2 or 3. Of course, it could just snap higher immediately, but I think the odds favour it's going to move back and forth within a range for a bit longer. I think this overall trend remains up. Nothing here suggesting otherwise at this stage, but it does seem like a larger pause to me, that seems like the more likely scenario. I think overall, the play here is cautious optimism. For me, it's about holding profitable positions, using those wide trailing stops. If this is in fact what plays out of consolidation, I want to be able to try and see it off, cut losses if the stock's not working, get it out of the portfolio, and being patient with buying. Wait for the right setups. Don't need to buy something every day, every week. Wait for the setups to look right, and they're the ones to have a look at. But yeah, I think maybe a bit of patience is required in this market yet.
Yeah, definitely a lot of patience. All right, let's have a look at the Hong Kong market. It seems to come off a little bit.
Yeah, bit of a pullback since last week, and we spoke about the pullback last week, and that's just continued to unfold over the last few days. Last week we talked about holding long positions. So if anyone had been buying into this emerging upward trend, having a good run, I thought the play would be, well, look, let profits run, give the market room to move, but generally hold long positions, see if the market can stabilize and move up. But at the same time, it didn't seem to be a point to be adding to positions or establishing a new position. It was a case very much last week of let's just see how this consolidation plays out. And that remains the case this week, just watching how this consolidation plays out. I think ideally we see the Hang Seng find support and stabilize around the moving averages. So this is a 50-day. If it can stabilize around the 50-day moving average, that would be an encouraging price action to see, and then maybe that could set up a new entry opportunity. But it's a little bit early for that yet. All sorts of ways this could play out. So I think it's just a case of holding long positions and just waiting for establishing new positions. There's also a support which we can put in. So just I'm just looking at this. You can line up these lows, and so we've got some lows and some highs. Comes in below the 100-day moving average. If the Hang Seng was to reverse and find its way back below that support, I think that would really it'd come close to negating the bullish potential this has. I think this is like an important level. We want to see the Hang Seng hold above 7,200. Below there, it starts looking like another bear market rally, which then comes lower again. So this is a good line in the sand to keep an eye on. Whilst above there, I think we keep an optimistic outlook on this, and we look for the potential for this market to stabilise and push higher. With China, just jump over to China quickly. Similar sort of story. More of a gentle pullback towards a 50-day moving average in the Chinese market. Pretty normal sort of price action, really. When you start seeing the early signs of an uptrend, it's going to have these periodic pullbacks to the 50-day average. We want to see that buying of the dip interest come in around this 50-100-day moving average area, and I think this is still a case of treating this as an emerging upward trend. And let's see whether this can keep over time making its way higher.
All right, fantastic look at the markets in general. Jason, just having a look at scanning some of the comments here. Obviously around our artworks, there's people just not really giving their opinion. So don't forget to vote which one you prefer, mine or Jason's, right? There's one here that says that yours looks like like a central desert. So I'm not sure there, Jace, but yeah, we can comment on that, who wins after that, all right? Who wins at the end of that. And don't forget to like and subscribe and comment on our video as well. It helps us, with the metrics, I guess, around these videos. All right, let's have a look at some general questions now, and we might start off with some we've had from the viewers in the past and we haven't got around to. So, Jason, what's the maximum number of indicators you use for trading before one gets confused with conflicting indicators giving conflicting messages?
It's look, I think with indicators, it's interesting when you look at some of the commentators on YouTube and on some of the pictures I see turn up on X and various news sources. You often see there's a lot of lines, a lot of moving averages, a lot of Fibonacci's, a lot of indicators, and sometimes I'll look at these charts and go, well, any which way the price moves is going to hit something. And so, like, how do you use that? How do you use something with so much on it that it's constantly going, binging off something? I like to keep the chart as simple as possible. There's nothing wrong with using a few indicators. So I primarily use the moving averages. That's my go-to. That works for me. I like the moving averages. 50-100 days. Nothing wrong with making it a bit shorter also. Sometimes a 10 or a 20 day if I want to be looking at things and want to be getting more movement. Nothing wrong with shortening the moving averages either. I think the moving averages are like they're a good underpinning control system for your whole process. As for adding other indicators, there's nothing wrong with having another 2 or 3 indicators on the go. Different people find use in different things. So I'll sometimes look at an RSI, but it's not a part of an important. It's not a significantly important part of my process. It's just something I look at from time to time when I see something there. Some people love the MACDs and use those. Some people love the Bollinger Bands, use those. Just trying to make too many indicators work at the same time, I think that can become confusing. So keep it simple and keep your indicators to a minimum. Find a couple of things, maybe 3 things that work for you, and see if you can test it out as well. and not just look for the indicator which fits the view you want to have at the moment. So, okay, I want to be bullish on this, but my RSI is not saying anything. The moving averages don't look right, but the MACD says something good. So there we go. I've got a support. It's be consistent with the way you use your indicators, and not just be trying to fit the indicator to suit your view, which is probably a mistake. That's what I'd say, Rog. Keep it as simple as possible. Nothing wrong with experimenting with a whole lot of indicators, but once you've experimented with it, see what it does. Does it add value to your process? If it doesn't add value, just take it off and keep it as clean as possible.
Yeah, I like that comment about not trying to fit indicators to your view as well, right? I noticed over time when watching other people, in classes and students around technical analysis, it's always them fitting it to what they think, right? So versus looking at it objectively sort of thing, right? So good comment, that one there. Next question actually is related probably to some of the comments that we're getting around Lovisa, which is the jewelry, the jewelry company, the cheap jewelry company. Actually, in Melbourne, there's a few, and I look at the shop Lovisa, and I know they do more than just the jewelry shop. I think they must have other businesses as well. But it's always packed, and so from a fundamental point of view, I look at these shops and I think, geez, that might be a good investment one day. I'm not sure. I didn't really look at it from a technical point of view. But I look at that how busy these jewelry stores are all the time, right? So, but related to going back to the point here around the question, right? So for stocks like Frontier Energy, how do you determine that it has still more to go, or it might drop straight after you buy? I get into this dilemma all the time. Now, obviously, there's some people here on the chat that have gone, I've got into Lovisa and I'm just looking at the chart now. It looks like they got in on the break, obviously 3 days ago, and 2 days has just been banged down because of CEO plans, right? So, there's the question, Jason. Hope you got that one.
Yeah, it's a really interesting one, because this is something which I think plays with the head of a lot of people. It's I think, and this is also why people like trying to buy the low, because they're thinking, if I buy after it's been rising, maybe it will stop rising, then start falling. So I want to try and buy something at the low. But of course, you buy it at the low, it might keep falling. So you don't get out of it by trying to do that.
I've lost connection. Hello, Jason.
Well, I'm back.
Yeah, you're back. Sorry. All good?
Okay. Internet dropout.
Quick.
Yeah. So I think, look, there's when you buy into momentum, there's no guarantee that momentum's going to continue. And momentum's a sign that there is interest in buying the stock. It's moving in the right direction, but momentum can stop. But the path of least resistance is going to be in the direction that the shares have recently been trending in. And you can use moving averages to help identify where that underlying momentum is. So let's actually go. Let's get a chart up, and we'll start with Lovista. What's the code for Lovista, Rob?
Lovisa is LOV. Love.
It's easy. Yeah. So look, this has been a stock which has been generally within upward trends quite a bit over the last few years. Of course, it's had its corrective periods, but there's been plenty of upward trending as well. Now, someone could have just recently bought this is, you can draw some resistance across there. And when was that? That was on Friday. Friday, it broke higher, broke above resistance. It was rallying off the moving averages. If we look at the price on Friday, it's a bit hard to sort of do that, but just imagine you can't see this part down here. You'd say, well, look, the trend is up, it's breaking higher. odds favour going with the trend. But as I say, you can never be sure. Sometimes the market will just fall back on itself. There'll be a news release will come out and send the share price lower. It's going to happen. There's nothing we can do about that. I think the best we can do is to just do what's right. Do what's right is for me, it's buying into strength, buying breakouts. Every breakout won't work. You can do all the right things and still make a loss. It's about doing the right thing over and over, and then over time, the overall outcomes are more likely to go your way. And yeah, look, I don't think we should fear that every time a stock makes a new high, that it's about to reverse. Like, look at all these new highs that La Vista was making during other times. Plenty of highs led to more highs. So highs tend to lead to more highs, but a stock will always top out at some point, unless it's taken over, of course, and then have...
Oh, I think we might have lost you again, Jason. Hopefully it's just small temporarily. Yep, back again. No, you got to turn on you've got to turn on Jace. There we go, back.
Yeah. Did you get much of what I was saying then, or did we drop out?
I sort of drop out maybe a minute, maybe just, recall last 30 seconds maybe.
Yeah. Look, hopefully everyone's got the gist of that. I'm not sure. I'm not sure how far to rewind what I was talking about. But it's really about, you do the right thing, you follow the breakouts, you follow your process, and you accept that it's not always going to work. And that's why we have risk management strategies, that when something's not working, we go, okay, it didn't work. That's okay. Cut it, move on to the next opportunity. And we'll have a look at that other one, FHE. So that is Frontier Energy. And I was talking about this in my weekly strategy session on Friday. And it's an interesting situation, similar situation that we've got a breakout above. You can see you can see this resistance point. Well, it was resistance, it's now support. But broke above the resistance. It's a stock which is rising above moving averages. Moving averages are increasing, so it's got the characteristics of a stock which could go up a long way. But we'll only know in hindsight if this one does in fact go up a long way, or whether it stalls out and falls back. So what's the right thing to do with a trend following process? Well, it's to go with the breakout, use risk management. If it pulls back, take a relatively small loss. If it keeps running, let it run, wide trailing stop. So we're not about looking for perfection. We're not about looking to be right all the time. We shouldn't be fearful that we buy at the top and a stock falls back. It can be frustrating, but we shouldn't fear it. It's not a reason not to buy into strength, because strength often leads to more strength. All-time highs often lead to more all-time highs. It's just the way of how trends work. But it's hard to be a trend follower where you buy into strength if you're always fearful that the trend's going to end. I think you've got to take that leap of faith that some trends are going to go a very long way, and if I'm going to participate on that, I've got to buy as the price is rising. Of course, you can also always buy pullbacks to moving averages and such, but you're still generally going with an upward motion.
Yeah, and I think this actually question from Linda is quite relevant here. So, Jason, 3DA, if you want to just switch to 3DA traded yesterday below the motion trader stop loss, but closed at the end of the day above. Does MT use the low or the close price to trigger a sell?
So there's different ways you can do your trailing stops. I do. I work on the basis of if the trailing stop is hit at any time through the day, it's the trade ends. I don't work on the closing basis, because I come from a background where I've traded futures markets, and futures are a leveraged product. And if a market's going against you, you don't want to wait until the end of the day, because it could go a whole lot more against you with a leveraged position. So it's just cut the position. If it's not working, hits your level, you're out. I think that's generally look, I guess if you've got a portfolio unleveraged shares, maybe it's okay to work on a closed basis. I think over time it probably doesn't make a whole lot of difference. But the motion trader way, my way, I think the most appropriate way is probably doing if it touches during the day, it triggers the stop. What I do myself, I'll look at what stocks have hit their exits at the end of the day. And so in that basis, it's kind of working a little bit like on a where did the market close basis, because I don't actually sell it at the time that the trailing stop is hit. But if the market does bounce like we're seeing in this stock now, I'll generally just take it as an opportunity to get a better exit point. It'll usually still lead the portfolio. Or another option I'll sometimes use is maybe I could let it run a bit, and I can just say, look, if it comes back to the trailing stop again, I can cut it. There can be different ways you play around with how you finesse an exit. But yeah, generally, I'd use the rebound as an opportunity to get out at a better level. Sometimes it'd be a case for saying, look, let's see if it runs a bit further. I'll look at the chart and I'll make an assessment on it. But yeah, no, this stock will leave the motion trader portfolio.
Fair enough. All right. I will. I'm just sort of jumping around with the comments and questions here just to see what's relevant to what we're chatting with now, right? So I'm going to go right to the end here. Would you say that FME by the breakout is more asymmetric than the recent LOV breakout? So which one's more asymmetrical? Which one?
Well, I prefer FHE because it's coming off a longer basing period. So I look at this and it's had a big rally through 2022, and then 23 was all about the decline. Through late 23 into 24, you get this sort of rounding basing structure. You've got a clear overhead resistance. It's a stock which there hasn't been much heat in it. It's been a stock which has been cold. It's been cold and it's now starting to warm up. So I like those setups because it is getting in at a lower point. You're getting into a stock which hasn't done too much so far, and it just seems to me that can be a time where you can get some really nice upside when a stock which has been out of favor, no one's really looking at, starts to turn and starts to run. And from a managing risk perspective, it's like, look, you can manage risk on both quite simply. Like you just say from the breakout point, just back in this FHE. Maybe it's you could have a 15% stop or something back to, well, this is on the initial breakout. You could have had a 15% stop back just below the 100-day moving average, maybe. Then we go over to LOV. You can still have tight risk management on it. So okay, like we've got the breakout. Let's just put the stop back below the 50-day. So again, it's around 10-15%. So both can have that 10 to 15% exit point. So then you go, okay, so we've got our risk percentage is similar. What's our upside potential? So I just look at this chart and it's like it's already run a lot since the October low. It's had a big run, and it's like, is it going to continue running at that rate? It could, but I'm always, stocks which run a long way, I'm always wary of longer consolidations. Kind of what we've been talking about with the ASX and the S&P, that big runs, longer consolidations. Whereas when I look at FHE from an upside potential, it seems like the upside potential is a lot more open. So whilst risk is similar percentage-wise, upside in FHE seems to have greater potential. Whether a stock delivers on its potential is always another matter entirely. But this is a sort of stock which I could see potentially double from current levels with a 15% stop. As it's not hot, it's been cold and it's starting to warm. Whereas come back over to love, how much further can it go? Could this double from current levels? It could, but I'm probably less. I think it's lower potential to double in the next 12 months than the FHE. So yeah, I think FHE probably would have been the more asymmetric of the two breaks. And this isn't a cold stock which is warming. This has been a hot stock which just came off the boil, and is it going to get hot again? It's like I prefer the colder warming scenario. That's just a preference. There's these stocks which have been running for a long time. They can keep running, as we've seen with La Vista from February last year, and then October 21, strong periods, had consolidations, and then ran again. It may happen again, but yeah, that's how I just assess it.
No, good one. Love it doesn't seem to be giving us much love at the moment, right? So we'll just do one more question, and before we get into having a look at some of these tickers. Sorry, it was from Bernadette. SVM is interesting. Maybe massive spike last week. Just responded to an ASIC query re-spike in volume and price. Do you consider this a warning sign that something out of the usual trading pattern is going on?
Yeah, I talked about this in the my strategy session video on Friday. It's an interesting stock. They're aiming to develop the world's largest rutile deposit in what country is it? It's I think it's Malawi. It's an African country, Commonwealth country, and Rio Tinto's involved. So it's one of those situations where there's a really interesting story behind the company. I like that with this one here. I like how we've got this. This really is a nice rounding base, more so than FHE. You can see how the share price has been rounding. Strong upward period. We've gone through that long consolidation, and now we're breaking out. It's yes, I think there's definitely, like with ASX queries and stuff, it's like I don't know what's driven the I don't know what's driven the recent spike. I don't think there's any new developments from the company, but there is an interesting story. So who knows, like who's watching the story, who's tapped into it, who's accumulating the stock, and that's what we're using price action for. We're using price action to alert us to areas of interest. So whilst this was just trundling along sideways through 2023, there wasn't much to alert us to. There was nothing going on. But this is the thing with momentum. Momentum is sort of like puts a spotlight on areas where there's some activity. So the spotlights come onto this. I think it was a motion trader signal in March on this initial break higher, but that initial break higher led to a pullback. And this, like we were talking about earlier on about people being worried about buying a stock that instantly falls back. Sometimes the momentum will initially stall and come back, but it can still, the underlying tone can still be positive, and that's why we've got those risk managements to give it a bit of room to move around, which has been successful so far in this case, and then the upward trend has resumed. So the momentum's telling us there's something potentially going on with the stock. But as we always say, there's no sure things. So it's have the risk plan in place. If it plays out to the upside, great. If it runs, great. But if it doesn't, got a plan. Got a plan to get out and reverse position, protect capital.
All right, fantastic. All right, let's start having a look at some of the tickets that have come through then. MGT from Jacques right from the start.
So you can see where this has come from. It's come from great heights to deep lows, and moving averages turned positive for the first time in a couple of years. So look, there's a potential of something something positive happening here in that price has gone from below to above the averages. The averages have crossed. Like some of these bombed out stocks, they never recover. They just continue to just go back and forth bounce along the bottom for years, and then from 33 cents, there's nothing to say it can't just trundle sideways and then go lower again in the months or years to come. So got to be careful with them, because it's not a case of everything that goes down has to come back up. Some things stay down. That said, if you like a story behind a company like this, I don't know anything about it, but if you like a story behind it and you've been patiently waiting for the signs of an upturn, well, then you look, how do you manage risk? How do you take a position to manage risk? And if we just work some stuff out from current levels. From current levels, it's probably, you're looking at 25 to 30% to get a stop below the 100-day moving average. Like maybe one play would be just to have it on a watch list now, because it could be a case we've had this initial run and now we get that sideways consolidation. The price compresses, the moving averages catch up, and then we get a secondary breakout. And it could be a case of buying if it comes back to the moving averages. So you're buying the dip, have a relatively close stop loss below the moving averages. So it could be around 20-25%, which is probably a pretty reasonable stop loss on the low price stock, which is volatile. Or another option would be see if we get the consolidation and then buying the breakout, and then having a stop loss back maybe midpoint within the range. There are a couple of ways to play it where risk can be quite nicely managed. If it were to run now, look, if someone really liked it and didn't want to miss it, a position could be bought at current levels. Stop loss, I think, would really need to be below the 100-day moving average, because this could easily come back to the May low, which is around where the 50-day moving average would be. Could easily come back to there and just be part of the consolidation of this initial rally. So buying it now, I think you need to give it plenty of room to move around. The patient approach would be see how the price action goes, but the risk is that it quickly shoots higher and you miss it. So you got to weigh up a few things and working out what the best approach for you is. But yeah, again, what goes down doesn't have to go back up. So you always got to keep that in mind.
All right, let's have a look at XNAS. Is it an American stock?
That's a NASDAQ tracker. Is that the right code? NXAS?
AMD, it says look at AMD XNAS. So AMD XNAS.
AMD. So maybe it's the NASDAQ. AMD.
Yeah, maybe, yep.
Okay, let's have a look at that.
David at Mac, if you want to just confirm what that was. If you get time, we'll go back to it.
I think it would be. I think it would be AMD on the Nasdaq. That would make sense with all that.
Oh yeah, obviously Nat and X. Yeah, all right, okay. Yep.
Yeah, I'm just looking and I like to compress the data, like see where this has come from over time. It's like I'm not sure of the near-term direction, because it's lost this immediate upward momentum. It's not in a downtrend. It's not in an immediate uptrend. It's maybe we're just in a consolidation phase. It's a sort of stock that if I had it, I'd still have it. I think it's been a pretty it's a bit of a spike high. Yeah, I think with a wide ATR stop, I think the stop would still be below the current price action. So from that perspective, if I had it, which I don't, I'd still be holding it. I'd see whether this is just part of a pullback, correcting the large rally it's had over the last year or so. Maybe there's a period of sideways price action. Maybe it re-engages with the uptrend. So it's sort of position I'd let run. No one regularly, repeatedly sells at the highs of these things. So like you see these spikes higher, spikes often is like a bit of a crescendo before there's some sort of a pause, and we're certainly getting that pause now. But the underlying trend is overall, I guess the underlying trend is still up, although there's no immediate momentum. So if I didn't own it, I wouldn't buy it at the moment. It's just see what the price action delivers over the next few months. But if I had it, yeah, it's probably still above my wide trailing stop.
All right. What about IRI back on the ASX now?
Yeah, I was talking about this a few weeks ago, in that turned up in the motion trader signals in late April. So it hadn't been doing much for a year or two, and then just started to get this momentum above the moving averages. The moving averages crossed, and then it just took off. So it's a sort of stock that, if you got in on the original motion trader signal, well, I'd certainly be holding it to see where it goes from here, giving it plenty of room to move around. But I'd be less inclined to buy it at current levels, because it's still stretched above these moving averages. I'd just probably want to see more price action play out, let the averages catch up. There could be another entry signal in the near term, I guess, if it does continue to consolidate over the next. Might need a few more weeks. Let the moving averages catch up, and then you start getting a base developing at a higher level, and then if we do see some sort of a range develop in this rectangle area, moving averages catch up, and then maybe it's a case of buying near the moving averages, or buying a breakout from what could be a range developing. So there could be another entry opportunity in the makings, but at the moment I'd probably prefer just to watch it. But as I say, if I had it, I'd certainly be holding it with a nice wide trailing stop.
Yeah, good one, that one. IPX.
We must have spoken about this recently, because I've got the all the ranges marked out. So, will this current breakout work out like the previous breakout? It's the same sort of setup, in that we've got a market which rallied, sideways consolidation into the moving averages, and a couple of tests of the moving averages. So into the averages, rallied back to the average, and that's what forms a range. Done pretty much the same sort of thing in this most recent period, and we've got a break to the top side. Could this turn out like LOV, where you get the breakout and then it falls back within the range? Well, that's absolutely possible, and that's why we have risk management. But it could also do what it did previously. So we don't know which way it's going to go, but it's asymmetric to the upside, in that we know where we can manage our risk. Our risk can be managed by having a stop just back, maybe just back below the 50-day moving average, even a little bit higher. It's interesting. You look at this price action from November, where it broke to a new high, but then that was the peak, and it came back in well within the moving average. Came well back within the range. It could be the case that it has broken a new high, but it does then come back within the range, and it's not until several months later that we're going to get a sustained breakout that works. So there's all different ways these things can play out. So how do you set a stop loss on that? Well, you could have a stop just below the 50-day moving average. I guess below the 50-day moving average gives this breakout plenty of time just to briefly pull back within, a shallow pullback within this range, and then rally. But it's asymmetric in that we're capping the downside, but the upside is open-ended. It has potential to continue going up wherever it may go. But yeah, look, I prefer buying these things at lower levels, buying these setups at lower levels rather than the later ones. But some of these later ones, they can continue rallying for a very long time. So it's yeah, it's certainly an opportunity which is to be considered.
All right. What about Duratec?
So this was a motion trader stock, and I had this myself, and hit the stop loss, a trailing stop. It was here. It was in February, in late February, and I got out a couple of days later. So this is what we spoke about this earlier. Do you sell during the day when it touches, or do you sell based on whether it closes below the stop? Well, this closed, from memory, this closed below where the stop loss was, but I didn't realize it hit the exit during the day. I looked at the end of day data, said, okay, it hit the exit, opened the next day and traded higher. So I let it trade higher for a couple of days, and then I closed my position out maybe about $1.30 or so. The low had been $1.17. So I was just able to get out a little bit of a better level. But you can see the whole structure's now changed. So using those moving averages, so use the moving averages, I think, as your basic structure for working out, is a stock bullish, is a stock bearish, or is it neutral? And this has gone from a situation where it had been consistently above the moving averages, so it's bullish, to now it's spending a lot of time below declining moving averages. So it's now bearish. It's no longer a motion trader stock. It got out when we had the fall, hit the ATR based trailing stop. Moving averages have now crossed to the downside. The rebounds are just coming up to beneath the averages and then selling again. So you can see there's distribution. It's now a case of no longer a case of buy the dip. It's a case of sell the rallies. And again, we're having another one now. So is this going to be a buy that is this a dip to buy, or is it a rally to sell? Well, I'd suggest that it's probably a rally to sell. I think the odds favour that this will break lower and make a new low. Now, of course, I could be completely wrong. Maybe this is the low, but I'd just look at this as a little congestion zone here. Like, which way is it going to break out of this? I think the odds favour that it's going to it's going to hit. Well, it's hitting the top of the 50-day moving average. It's going to break to the downside. I think the odds favour that will happen. The path of the least resistance is lower. So it's certainly not a stock to be buying, and as we discussed, it's a stock which I've already sold. So look, at some point it could make a low and then be off to new all-time highs. I don't know, but I don't want to be holding and hoping that's going to happen. I'd rather just get out and then reassess if the price action warrants reassessing it at a later time.
All right, let's have a look at MAD, please.
Yeah, this was got a motion trader signal on this a few weeks ago, just as it looked like. So it went from below the averages to above, moving averages crossed, and this here taking up to a what would have that been? That would have been it was a multi-month high. Initially, it was looking good. Just looking at it through here, this is all good. So broke high, then we've got this shallow, or this narrow consolidation. It looked like it was setting up to break higher. But as I said earlier, we never know. We never know which setups are going to play out and which ones aren't. And since then, it's fallen away. It's now back within the range. So this is sort of like where I'd call a stock as being neutral. It's not bullish. It's not bearish. It's just trading sideways. It's going either side, oscillating either side of the moving averages. If I'd bought it on this breakout, I'd still have it, would still be above my stop loss. I'd be using a time stop as well. So for me, I work on 60 trading days, or about 3 months. So I'd have 3 months to sort of stabilize and break higher. But then I'd say, look, okay, it's not working, move it on. Or just also nothing wrong with, like, if you're in a stock like this, the stop loss may be below the range, keep it below the range. It's like, sometimes it just doesn't go your way and you sort of get in at the highs and it does pull back. Other times you get in and it continues to run. As I say, we just don't know which one will play out. So the question to ask yourself when you're looking at these setups is it asymmetric? Is my downside relatively small compared to my potential? And it's always potential, my potential upside. If the answer is yes, well, then I think it's well worth considering. If the answer is no, it's marginal. Like, I might make 50%, or I might make 25%, I might lose 25%, it's 50-50, it's marginal. I'd leave it alone. And then accept we're going to get those losses along the way. Every setup won't give us a positive outcome, but over time, if we've got a good process and we consistently follow it, then our overall result should be, I think that's how you potentially get that good outcome over time. But with matter, it's back into a holding pattern at the moment.
Yeah. All right. Now let's have a look at Michael here. Seems like he's answered some of his questions around over analysis here, multi-time frame. So it was EWZ, looks like a beauty on the weekly, monthly turn up, tight band, daily pull up at the moment.
EWZ, this is an ETF. Would that be right? EWZ?
I'm assuming there's no Aussie. There's no Aussie one, is there? So
No.
a few. Well, maybe we'll go back to that one, Michael. Maybe you can confirm which market that one's trading on. Or if it's the right one.
Brazilian ETF. It's one which I do look at from time to time. But yeah, if Michael maybe just confirms that.
Let's have a look at CU6.
Well,
I'm nervous about this one.
Yeah, well, I've got this one in my portfolio, and it just keeps going up. This is why I don't take profit. It's because you just never know. It's going to be this. This isn't like a normal result, a normal outcome from a trend. Most trends don't do spectacular things, but some do, and it's and this one is just running. So I don't want to cap my upside by taking profits. I just let it run. It's going up near vertical at the moment, so it's one which I couldn't buy at this point because the near vertical rise it could continue on and surge again, but it's no longer, for me, it's losing its asymmetry in terms of, like, because I don't know, like, where do I put my stop loss now? Like, Motion Trader will use the stop loss for earlier entries, so we can calculate one, but it just starts getting too far above the stop loss, the trailing stop. It's also stretched above the moving averages. So for me, this is one to hold, is to let run, to see what happens, see where it goes. But it's for me, it's not an asymmetric entry point.
All right, fantastic. We might finish up on BIS, if that's okay.
Well, this is another one which has been running for a while, Bisalloy. And it's up again today. So it makes steel. It's they've recently got a contract to send some steel over to the US for their, I think it's for their submarine program. They make armored steel in the Collins class submarines, the Aussie subs. I think there's Bisalloy steels in those as well. But I think it's this US contract they've got, which has really ignited the trend. But the trend had been in place. For quite a while. So, like, an initial Motion Trader signal on this probably would have been back in September last year. And there's been a nice upward trend since then. And now the news is coming through, and it's continuing to validate the trend. So for me, I've got some of this in my portfolio from, it's a relatively recent entry for me. So I think I've only bought some a month or so ago, because capital is deployed elsewhere, and then the signal comes in for this at a later time for me. So I have bought some. So I do buy stocks at elevated levels, where I think the risk reward is manageable, because I hate just getting a signal going, well, it's gone too far, I'm going to just watch it now, because some of them do continue to run for a long way. It's nothing worse than knowing you should have bought something but you haven't, and it keeps running. So I've got a stake from a later point. I'll see where it goes. If I had some from a lower level, it'd be more exciting. And be, hey, well, look, I'm really up some good money now. Let's see where it goes. And that's, for me, that would be the play. Let this trend run, and see where it finishes up.
Yeah, and as always, have an exit plan when it goes against you, right? So, all right, we'll finish up actually on EWZ. It looks like you were on the right one. Michael's confirmed, I think. So
yeah, Brazilian ETF. So Brazil's an interesting emerging market. So did Michael say to look at it on a weekly chart?
Well, yeah, he's got a few multi-time frame.
Yeah, so
points.
we'll start.
It looks good on the weekly. Looks good on the weekly.
So it's like, is this forming? Like, Brazil's an interesting country from a natural resource perspective, from agriculture through to minerals. So if someone were to take a view that there's going to be a great shift to commodities, well, perhaps a Brazilian ETF is an interesting play. It's one I've been watching for ages, but I haven't mentioned it because it's never really quite set up just right. Like, is this a big base? Like, it's like we've got this large range that has been moving in since 2016. So which way does it go from here? Is this a base, or is it a holding pattern before it breaks to the downside? Like, there's no certainty into which way these things are going to break. I think there's a story there, but a story doesn't necessarily play out. And you can see I've got this little declining wedge. I had that in there ages ago when I was looking at it. Might have been there. I might have drawn that in over a year ago. Started to get a break to the top side, but it hasn't really continued it. The moving averages didn't cross till later, after it had started to roll over. So I've just left it alone. What's interesting is when you look at it on this is a US based ETF, so it's in US dollars. When you look at this shows you the difference currency makes. So have a look. So picture that. This is the US dollar version of the Brazil ETF. Now look at it in local currency, and it's a completely different story. So if you're a local, and if you're a Brazilian and you're trading in your local currency, the Brazilian market's been in a boom for many years. And this is due to the currency devaluation. So it's been better, rather than having your Brazilian real sitting in the bank depreciating. You've been better off being in the stock market, which has adjusted for the declining currency, because they've got some big mining stocks like Vale, or I think it's the world's largest iron ore producer, or one of them. It's like there's some very valuable companies within the market, so they just don't go dirt cheap because the market's falling. They adjust for the declining currency, and that's been propping up the. So when you look at it in local currency terms, it looks like it's a boom, but when you look at it in US dollar terms, it's not so flash. So it might depend what currency you're investing into, like how good this one has been. One to watch. I think there's a story, but I don't think, just looking at this recent price action, just quickly go to a daily chart. On the daily chart, the moving averages have rolled over, or it's now declining. So I don't think I'd be in a hurry to get in at the moment. And if I had bought earlier on this breakout, I'd probably be looking to close the position out and go, look, it's just not working at the moment, and move the capital elsewhere. Something interesting could happen, but probably, just looking at this daily, probably just not at the moment.
All right, fantastic. All right, so there's just a question there around trading software. Look, to be honest, we're using TradingView, right? So, I mean, we don't work for TradingView, but it's very popular around the world, and especially in here in Australia. So check that one out. If you're using Self Wealth, You can do the same thing we do on the self-wealth advanced charting system. There's just a few limitations on it, but you can put multiple EMAs and that's free, right? So, sometimes I think people that ask questions like, what's the best charting software? Like, it's kind of irrelevant, sort of, sometimes, in the sense that, hey, that's not going to make you any more money, right? It's getting the systems right and getting the way you exit and enter and letting your winners run and cutting your losers. That's the most important thing, right? So, but we're using TradingView, and if you're using the self-wealth platform, you can also check out the charting that we have on that very basic system that we have there, and there's some advanced charting features on that as well. I think the lastly, Jason, what everyone's been waiting for here, and that's the voting of our paintings. I think it's going to be a dead heat. There was a couple of comments at the start that were sort of on the fence, and that didn't really give us much. So there was the last two. We had one each. We're both winners, mate. That's the main thing. And the viewers are all winners from our session today. So thank you very much, everyone, for coming. Thanks a lot, Jason, for your knowledge and expertise once again, another week. And I certainly look forward to it all again next week. Don't forget to like, subscribe, put your comments in, and just remember, this is always general advice only. Do your own research as usual. Thanks, Jason.
Thanks, Roger. Thanks, viewers, for coming along and joining us again. And next week we'll be back.
All right. Good on you guys. Take care, everyone. See you later. Bye-bye.